Do you want to buy some cryptocurrency but feeling a little bit anxious about the price volatility? Or do you just need a place on the blockchain to park your currency in something less volatile? Let's talk about stablecoins. Hey guys, welcome back to the channel. Today we are talking about stablecoins. Just a reminder that nothing I say in these videos are financial advice. They're simply here for information purposes only. Now, as humans, stability gives us the feeling of control. We love to feel secure and in control of our lives. And if you think about cryptocurrencies and everything that you read about in the world around the price volatility, people making lots of money, people losing lots of money, they aren't the most secure place to be, or they don't give us that feeling of comfort and security. So you could be forgiven for not wanting to move your hard-earned fiat currency into cryptocurrencies. After all, as we've discussed, volatility makes us uncomfortable. They don't feel like a safe place to be. We always feel like we're at risk of losing our money, especially if we have to trade out at exactly the wrong time. Imagine you invest in cryptocurrencies. For some reason or the other, you have to withdraw your money. The prices have fallen a lot. You're going to incur massive losses. Now, fortunately, there are some cryptocurrencies that have more stable characteristics. Unsurprisingly, they're called stablecoins. What are stablecoins? Stablecoins are cryptocurrencies that are designed to maintain a more stable price and are often pegged to the value of a real-world asset like the US dollar or gold. The simple way to think about a stablecoin is that it is the tokenized version of a fiat currency or a commodity. A US dollar stablecoin is therefore a cryptocurrency that should always trade for a value of $1 US. Now, the most important thing that you should be asking at this point in time is, how do stablecoins maintain their peg? In other words, you're asking, why is a US dollar peg stablecoin worth $1? And can you trust that it will maintain that value of $1? Now, there are two main ways that a stablecoin maintains its peg. The first is to hold a pool of collateral that supports the stablecoin's value. And the second is to use an algorithmic formula that may control the supply of the coin to preserve its value. Let's start by talking about algorithmic stablecoins. The first thing to understand about algorithmic stablecoins is that while their value may be pegged to a real-world asset, like the US dollar, they are not backed by any real-world reserves. There are three main types of algorithmic stablecoins. Rebase algorithmic stablecoins control the supply of a coin in order to maintain its value or to maintain its peg to a real-world asset. Seigniorage stablecoins are a little bit more complicated. They rely on a mint-burn multi-coin structure where one coin is minted or burned to control the value of another coin. We're not going to get into the details of that, but it's just important to understand that it's one of the mechanisms that algorithmic stablecoins use. Third type of stablecoin that you get are fractional algorithmic stablecoins, where they are partially collateralized by real-world assets. Recently, one of the most popular stablecoins out there, the USD Tether, suffered a spectacular crash in May 2022 when it lost its peg to the dollar. Now, I'm not going to cover the details of what happened to USD Tether in this video, but I think for your own benefit, it's worth going and reading up on why and how the stablecoin lost its peg and why it resulted in many experts out there doubting the future of algorithmic stablecoins. So let's move on to talking about collateralized stablecoins. As the name implies, collateralized stablecoins are backed by some form of collateral that supports their value. Now, there are three things that you should be asking when it comes to collateralized stablecoins. The first is, what is the nature of the collateral? Is it good collateral or bad collateral? So let's take the example of a gold-backed stablecoin. You should want to know whether the reserves that are backing this gold-peg stablecoin are physical gold or cash. And as you can imagine, having a gold-peg stablecoin backed by physical gold is significantly better than having one that's backed by oranges, for instance. The second thing you would want to understand is whether the coin is over-collateralized or under-collateralized. And here what we mean is that if there are 1 million US dollar pegged stable coins in existence, then you would hope that there's $1 million of collateral that backs them. In this case, the coin is fully collateralized. If there's more than $1 million that backs these coins, then it would be over collateralized. And similarly, if there's less than $1 million of collateral, it would be under collateralized. The third thing that you would understand about collateralized stablecoins is, can you trust their disclosures around their level of collateralization? So if a coin says that they are over collateralized, are there audits of the reserves, or are you merely trusting their word? So the type of disclosure around the levels of collateralization is quite important as well. From everything that I've told you, arguably collateralized stablecoins should in theory be better than algorithmic stablecoins at maintaining their pegs. Now let's look at a couple of popular examples of stablecoins just in case you want to get your toes wet. USD Tether, not to be confused with USD Terra, is a collateralized stablecoin whose coins are backed by cash and cash equivalent reserves, or at least this is what Terra claims. But Terra has come under a lot of scrutiny in the market in the recent while because people have questioned the quality of their disclosures around the collateral. It's unaudited, you sort of have to trust their word, and there have been some lawsuits against them because of the levels of disclosure around their collateral. It's still one of the most popular stablecoins out there. It's been around for a really long time, and it's still the stablecoin with the highest market capitalization. USD Coin is one of the better stablecoins out there. It is also a collateralized stablecoin. Its reserves are stored in short-term cash or short-dated US treasuries, which should retain their value. Their disclosures are of an extremely high standard, and this is a coin that's generally been always over-collateralized. So it's a great option if you're looking for a stable US dollar-pegged collateralized coin. Another example of a stablecoin out there would be DAI, which is a US dollar pegged stablecoin as well, but has collateral reserves that are backed by cryptocurrencies. Now here you might be feeling like the collateral invested in cryptocurrencies would be quite volatile. There might be a high chance that the DAI would lose its peg to the US dollar, and you might feel less comfortable investing in a collateralized stablecoin where the collateral is actually invested in cryptocurrencies. So if you want to give cryptocurrencies a try, but you're just really worried about volatility, or if you're already invested in cryptocurrencies, but the markets are going crazy, there's a lot of volatility, you're feeling really uncomfortable, then stablecoins are a great place either to get started or to park your money during very volatile times in crypto markets. If you like the content of these videos, please don't forget to hit subscribe. Guys, thanks for watching this video. I hope you've learned a little bit about stablecoins. I'm Nelson. This is the Nurse Verse. See you next week.